Hi, Joe Lopresti here with the Arlington Wealth Management Proactive Strategy Update for Friday, January 13th. On this update, we're going to talk about the current conditions in the market. We're seeing a little bit more firm ground coming into the market here entering this week. We're going to review our economic model, and this is updated through the end of November. Important modeling showing that the recession alert is still intact, and we'll bring you up to date there. We're going to talk about seasonality. Our seasonality factors are still in play at the end of midterm election year, moving into the following year. Historically, a very strong time. We're going to just remind you that we're in that seasonality, that we tend to see better action in the market. And we're also going to bring sentiment, investor sentiment, into the discussion today. Sentiment got historically negative 3 or 4 months ago. It remains negative today. And that's used in a contrary way, and we'll show you some historical perspective of why that's important, and maybe one of the reasons why the market is being supported at this point, whereas many people think it shouldn't be, based on fundamentals. And then we're going to finish this update by looking at potential asset class shifts that are taking place. We talked about the growth versus value stock shift that started about 2 years ago, how important that was, how value stocks outperformed growth stocks for the most part in 2021 when the market was rising, and then how value stocks outperformed again last year when the market was dropping. Well, so far in the early part of 2023, we're still seeing value stocks outperforming. Now we're beginning to see evidence of another significant asset class shift, and this one could be even more important because it's more globally in nature. And we're going to talk about those opportunities as things are developing. Well, let's start off by looking at our overbought, oversold indicator. And we could see that the global stock index, which started off after our latest buy signal wavering a bit and drifting even out of the bull trend channel for a while, now has firmed up and has moved back into the bull trend channel. The latest action in the market looks significantly better than it did toward the end of the year. And we may be able to attribute some of this weakness to some tax loss selling that came in towards the end of the year. With stocks down meaningfully in 2022, there could have been some additional selling pressure that held back the start of this buy signal cycle because as we turn the calendar, things definitely improved to the upside. We monitor a number of different global vital signs when we get a buy signal. There's 7 different types of measures that we look at to see how any particular signal is tracking relative to previous signals. And for a while, almost all of those were tracking negatively as though this cycle was going to be a failure. Now we're seeing a couple tracking positively towards similar evidence of a successful buy signal. They're still, the majority are improving and still look relatively weak, comparatively speaking, from a historical standpoint, but we're seeing improvement, and there still is a very good possibility that this buy signal develops into some sort of sustainable market opportunity, whether it's short-term, intermediate term, or even a bit longer term in nature than many people think today. It's the evidence that we go with, and right now things are beginning to improve from a quantitative perspective. Let's start off by looking at our leading economic indices. We run a couple of different iterations of this look, and the objective is to give us a potential warning of an upcoming recession. The weekly leading economic index, you could see, is still in negative territory. It did turn up a little bit at the end of November. So there's some marginal improvement, but nonetheless, it's still flashing that we're below the zero line and we could expect a recession. You could see previous times it drops below the zero line. A recession does, in fact, begin. There can be some false negatives, but they're pretty few and far between. And we also run monthly version of this index, and both of those are also dropping. The blue line is what we consider a very long monthly leading economic index. The red line is a monthly leading economic index, but not as forewarning in nature. And you can see both of those indices are still below the zero line. The long leading one actually dropped further in the last month. The leading did turn up, but just marginally, and those small little upticks are not something to really hold on to in the sense that we would expect a major turnaround in economic conditions. So with these important economic models still negative, the outlook is for a recession. We probably should expect that to start sometime this year. We've talked about how the market tends to fool the majority of market participants, and the majority of market participants today expect a recession. It's the most widely anticipated recession ever. So perhaps this time is going to be different. It's always a possibility. It's interesting to see some strength building in the stock market. We wouldn't expect to see that if we're beginning to move into a recession sometime in the very near future. So one surprise could be that a recession occurs, but not for an extended period of time, and that gives the market some time and some runway to advance higher for a period of potentially several months before the economic headwinds really matter in terms of equity prices. The other scenario is that we experience a recession, but it's very mild, and we may be in the midst of it. And oftentimes you see these indicators bottom when we're in the midst of the recession. So that's always a possibility. The market dropping 24% from high to low last year as measured by the S&P and most other major indices down the similar, in some cases even more, like the NASDAQ, that may have accounted for a downturn in economic conditions. And we may be in a position now to capture the upside as the economy recovers. However, more than likely, there's a recession ahead. It's very possible that it could be more severe than people anticipate. While most people anticipate a recession, many expect it to be mild and short. So the surprise could be in the other direction, that it's not short and mild, it's deep and maybe lengthy, in which case we would expect to see some further downward in the equity markets at some point as that recession takes hold, as corporate earnings drop during a recession, and that's typically when another leg down in the market occurs if that scenario plays out. Now we're going to be entering corporate earnings season. In fact, today it kicked off with the big banks announcing earnings. In a couple of weeks, we'll be getting some of the big tech companies announcing earnings, and I believe those are the important ones as they carry the biggest weighting in the S&P. So what companies have to say, not so much about what happened in the fourth quarter and the earnings they're reporting, but how they see 2023 playing out and beginning to give their forecasts could be very important in terms of the future direction of the market. What could be supporting the stock market, given the fact that earnings seem to be struggling at least a bit? The economy seems to be struggling in many ways. The labor market certainly is holding out, and that may end up at the end of the day supporting the economy from shifting into a recession or at least a severe one. But many parts of the economy, the housing market and the auto industry seems to be struggling significantly right now. And those are big parts of our economy. The technology industry, the big companies are, for the most part, announcing layoffs from the mega cap tech companies. That's a big part of the U.S. economy. So what could be causing the market to sustain a bit of an uptrend here if fundamentally things aren't looking so rosy? Well, we want to point out that we're still in a very strong seasonal period in the stock market. We've looked at this chart a number of times. For those of you who may not have seen it before, this is the average two-quarter market performance by presidential cycle from worst to best. The worst two-quarter performance ended with the third quarter of last year. So that ended September 30th. Notice how since that time, stocks have lifted up a bit, and that was, at least so far, the weakest part of this bear market. Now, there may be another leg down coming in the future, but what we know for 2022, stocks put in a bottom in October. We're in really the strongest season. So if we look at year 3, which is what we're in, the third year of a president's term, quarter 1, which is what we're in right now, is the best two-quarter market performance. So adding in the fourth quarter of last year and what happens in the first quarter of this year, historically, it's the best time for stocks. And that's followed by the second best time, which is the second quarter this year. So this current quarter and the next quarter, seasonally, we're in the strength in a presidential election cycle. And even if we get into the third quarter of this year, it's a strong period. Another way to look at how the presidential election cycle plays out is looking at it in this format, looking at every midterm election year, going back here to 1962. You could see each and every year experienced a pretty significant correction or bear market. For example, in 2018, there was a 20% drop from the high to the low during the year. In 2014, it was much more shallow. But you could see historically, midterm election years get a 16% drop. That's bigger than most other years. Last year, the S&P dropped about 24% from its high to its low. So it definitely followed suit for seeing that weakness during a midterm election. The second takeaway is what happens 1 year after the election. And what we could see is the median rebound is 27% 1 year from the low. For example, in 2018, after dropping 20%, 1 year later from whenever that low was put in place, the S&P was up 37%. So if we look at 2022 and put it into this cycle, the low came in October, and we are up from that low. We're at about 4,000 on the S&P, but if we get the median rebound of 27%, that would target a little over 4,400 for the S&P, or about 10% or so upside. Let's call it 11% upside from here. And that would occur in October of this year. So 1 year from the low was October 2022. We could potentially expect a high in October 2023. Of course, these are averages over many years, and a recession could certainly throw some wrenches into this type of outlook. And we don't use this analysis in our money management or decision making, but we do keep it on a back burner. And then when our models, like the buy signal that occurred in November, line up with these potential seasonality cycles, it's something to point out and understand. For whatever reason, this is a tendency in the marketplace. Another thing we'd like to look at that we believe is supporting stocks here in the last few months is investor sentiment. Investor sentiment is taking measures in surveys and polls from investors in terms of how positive or negative or their outlook. Investor sentiment measures tend to be used as a contrary indicator. In other words, when sentiment is negative, it's generally a good time to buy stocks. And when sentiment's positive, it's generally not a good time to buy stocks. So, and why is that? Well, because if most investors are negative, they have already cast their vote in terms of how they expect the future to play out. And if they're negative, they expect stocks to go down. So they've already sold. And therefore, that supply is already factored into stock prices. And vice versa, when investors are positive, many of them have already placed their bets, they've invested their money, that demand is already reflected into stock prices at that time. So one of the more popular polls is conducted by the AAII, American Association of Individual Investors. They've been doing this for years and years, and they conduct a bull-bear spread. In other words, how many of their members are bullish versus bearish. And what we could see is the latest reading is there's about 15% more members bearish than bullish. It's pretty rare to have more people negative than positive. The median is positive. Most times when they conduct this poll, there's more people bullish than they are bearish. Well, not only is it bearish, but it's been bearish for a full year. It's never gotten above the zero line, going back to right around this time last year when it, finally moved into negative territory. We could see when the high occurred here, that was a bad time to buy stocks, and that's exactly why this is used as a contrary indicator. But what I'd like to point out is this right here. As we went into the middle to, let's say, third quarter of last year, investor sentiment got historically negative. We were sitting down here with 40% more bears than bulls. We could go back to times in the past, and those were bottoms of big bear markets. Even the financial crisis didn't get much more negative than that, and did it for only a short period. Looks like back here in the early 1990s was the only other time that this poll got that negative. So, we think that investors largely became over negative, if that's a word, and expected bad conditions to continue. They cashed out, and that created a lack of supply in the marketplace. And when that takes place, then all it takes is a little bit of demand to turn the tide. And that's what could be at play here with our market model moving back to positive at the end of November. We have the seasonality behind us. We still have people expecting bad things to happen. And as I said earlier, the market tends to fool the masses. And if most people expect the market to go down, well, then it could very well do the exact opposite. One thing I've learned over my 37-year career is the market has a logic all its own. And that's why we built models to help us understand tendencies and directional movement so we could make unemotional decisions for our investors. Well, we showed this chart in our last video update, and I think we struck a chord with many of our clients, and that came up in a number of discussions this week. And what we're looking at is the U.S. stock market returns compared to the rest of the world returns, and going back over a number of years, right? So this is at the beginning of 2008. Of course, we had a major bear market with the financial crisis, and both the U.S. and non-U.S. stocks dropped. But once that bottom was put in place, we got a recovery in both. But then there was a major separation right around here in 2011. The U.S. stock market took off. The rest of the world went sideways and consolidated and continues to consolidate. So there's a big spread between the performance over the last, let's say, decade plus in the U.S. market relative to the rest of the world. This is very rare to occur. It has occurred in cycles in the past as well. But this is something that we really want to hone in on because we talked a lot about the potential for a lost decade. And when we talk about a lost decade, what we're really talking about is a lost decade in the S&P 500. That's just one asset class. Only the U.S. has a lost decade outlook from our perspective. Investors with a U.S. mandate where they have to have the majority of their assets in the United States, or investors that have allocation models, traditional ones, that may allocate a little bit to the foreign markets, but they're just more minor token type of allocations. We think they're going to have a hard time. Investors waiting for the leaders of the last bull market to regain the spotlight, we think they're going to be waiting a long time. History shows us that once an asset class like U.S. megacap stocks go through a decade of enormous gains like they just finished, they tend to struggle. So I think you're going to be waiting a long time to regain the previous highs of some of these U.S. megacap stocks. Meanwhile, investors without a mandate that have total flexibility in how and where to direct capital will not likely experience a lost decade, in my opinion. In fact, arguably, there's potentially more opportunity in the next 10 years than we've had in the last 10 years if you know where to look or have the guidance and advisors to guide you in the right direction. Let's take a look at a couple of examples. Well, this is one of our long-term momentum charts. So we show you the long-term momentum indicator for our global stock index. It's part of our modeling and our market model to identify positive and negative cycles. Well, we run the same indicator for all of our asset classes. And in a minute, I'll show you our asset class ranking system, and that has well over 200 asset classes of all different types, including many of the foreign markets. Pretty much any market that we would consider investable is included in our asset class ranking system. And there's a few that I think most asset allocation models would never consider, but sometimes those hold the best opportunities. But what we're looking at is the long-term momentum of the EFA value. That's a funny sounding name. EFA is the most commonly followed global stock index. I shouldn't say global, I should say foreign, non-US stock index. It stands for Europe, Australia, and Far East. So these are the developed countries, non-US. Western Europe, Australia, Japan, South Korea, the big developed economies of the world are included in this index, except for the US. They don't include Canada, not sure why. That's just the way that they run the index. But what we're looking at is the long-term momentum, and it did turn positive at the end of last year. Now that itself is important, but what the bigger takeaway, in my view, is looking at this index and going back over a very long-term period. And what we're seeing is today, it's trading at the same level it was back here in 2005. In fact, at the recent low last year, it was trading at the same level that it was in 2000. So think about that. These are big economies around the world, developed countries, and their stock market has gone through a 20-year period where it hasn't made any progress, none. And that's not even adjusting for inflation over the last 22 years. Now, these are just the value components of those foreign markets. And this could be a sweet spot for investors, even if the U.S. stock market struggles. Now, investing just because there's been no growth for 20 years is not necessarily a great strategy. However, when that type of analysis and opportunity is there, coupled with the evidence that asset allocation leadership is beginning to shift, that could potentially set up a wonderful opportunity. You know, if you look at this period here from 2003 to 2007, when this asset class, the foreign value stocks, boomed, that was during the lost decade of the U.S. stock market from 2000 to 2010, when the U.S. stock market didn't make any progress during that time. So we continue to keep an open mind with our asset allocation, with our positioning of our strategies based on the market. We're obviously seeing cross currents with our models, with the market model pointing up, economic model pointing down. Nobody knows exactly how this is going to play out, but we could track the evidence. The evidence is beginning to show some positive strength developing. Of course, any negative earnings could reverse that, and it could happen very quickly. But we are seeing some very interesting things develop from a global perspective. We think that this is very important, and in fact, we're considering putting on a special webinar maybe sometime in February discussing these important asset allocation shifts in leadership that we see beginning to develop. Well, that's going to wrap up this update. Thank you so much for watching, and enjoy your weekend.